All right, welcome back to the iWealth podcast. Me and Brad from iWealth are talking all things financial, and in particular, I heard this the other day, and I'm going to grill you on it, okay?
Yeah.
What I heard the other day was that you have stocks, and then bonds are always the ones that are like a little more sedentary, right? Like they just don't move as fast, and they're quote unquote safer than what the stocks are, right?
Sexy as stocks.
Exactly. So, but what I heard the other day from another financial guy is he was saying that bonds are so volatile that there's no safe place right now in the market. And so where it used to be, you want to be safe, so then we move you over into this bond thing. Well, right now that's not happening. So we're having these two things that are happening at once. There's no safe play here. If you're in, you're asking to be volatile. What do you think of that? BS.
BS. And here's why. Not all things are created equally. So let's just talk about bonds. A bond is a loan. It's a debt. So if the city of Mankato wants to build a school, they would issue bonds. They don't have money to build a school. They'd issue bonds. Let's say that they pay you 4%. And so you borrow them $10,000, they pay you 4% interest, and in 30 years, it matures and you get your money back. That's a bond. It's a loan. And it's the reason why it's not as sexy because they don't go up and down as much. They're not like stocks. They're not equities. You don't own them. You're loaning money. Well, there's different bonds. So if I loan money to the city of Mankato and I got to count on Mankato paying me back, they can raise taxes to pay me back, right? If I loan money to a small publicly traded company, let's say I loan money to, not small, Harley Davidson is a mid-sized company. I loan money to Harley Davidson for them to build more plants. Is there a better chance that Harley Davidson might not be able to pay me back than the city of Mankato?
Yeah.
Right? And so not all bonds are created equal. So what the advisor is really talking about is correlation. And what correlation means is that if stocks and bonds go up together, they're highly correlated. But if you own the correct set of bonds, they can offset the risk of stocks.
Okay.
And they're not guaranteed. I mean, things fluctuate, but they don't fluctuate like stocks do. There are periods of time where they can act correlated.
And is this one of those times? Is that why?
No, it's not. Oh. But there has been times. So I've been doing this 30 years. There's been times where bonds act like stocks, but they don't go down as much. So let's say stock market's down 19, maybe bonds are down 3 or 4. But they acted together because they both were down. It wasn't quite the hedge, but they don't have the same volatility that stocks do. So that's why I call, like, you got to know the context behind the statement of what they're saying. So I still think bonds are a good hedge against volatility, but they need to be bought correctly and it needs to be the right bonds. But that's super interesting because it got your attention, right?
It totally got my attention. And I was like, where's the truth in this? I don't know.
Well, and then throw in gold, throw in Bitcoin. Where are those? People are using gold now as a hedge because of inflation could come back and, what's going on geopolitically and all those other things. Some people think Bitcoin is, even though gold is physical, Bitcoin's not. I mean, it's just, there's all these different talking points that are out there. The bottom line is this: diversification's key. And you can have a stock and bond portfolio that are diversified. They don't have to work in tandem. But that's super interesting that you heard that. And it doesn't surprise me because there's all different types of talking points and things. And I did, by the way, this is just my opinion too. Somebody else could be sitting over here and have a different opinion. Just I'd call it wisdom over the last 30 years of helping people save and accumulate money.
I like it.
Yeah.
All right. Well, now you know.
Thanks, Matt. Have a good day, everyone.